Will inflation lead to a massive disaster of a deleveraging collapse in the United States? That is, will inflation be so bad that we could potentially see mass bankruptcies at corporations and households and mass foreclosures in real estate, leading to a great reset solely because of the massive amounts of money printing we have done in the United States? Or is there an alternate path where we just go back to normal and forgive the money printing that has happened? In this video, we're going to go through two scenarios and what the results might be of each. Between 2019 and 2020, our money supply expanded 24.6% after all, from $15.3 trillion to $19 trillion. And this year, we're expecting to add another $1.9 trillion of stimulus-related debts, which we've already passed that bill, so I guess that expectation is now reality. And we're expected to potentially not only run a budget deficit in the country, but also add maybe another $3 trillion in infrastructure spending. This means we might beat the money printing that we did in 2020. And this is creating a lot of concerns. What direction are we all possibly going to head in? And is there even an alternate to what's coming? After all, used car prices are up 14%. Copper prices are up over 30%, all just within the last year. Lumber prices are up over 250%. Rent is up. Sure, things like apparel prices are down, but they're down by nominal amounts, like 2.5%. Everything else is skyrocketing. You go to the grocery store and somebody tells you there's no inflation, you just laugh. I mean, have you seen the asset price inflation? The stock market? The housing market? Yet at the same time, the government's consumer price data shows that inflation is just 1.7% year over year, and up less than expected on a month-over-month basis. Are we just being duped? Is this data just a lie? After all, we know the CPI has been revised multiple times in the past. Is this potentially just being revised in a way that manipulates the data down to hide the nasty reality of the inflation that we really have? So I spent my Saturday morning drinking coffee and doing some research. I first wanted to start with some data. Where the heck is all of this money going? If you print all of this money, it has to go somewhere. And once we know where it is, maybe that can help us understand what might happen in the future. Okay, so here's what I found. When I searched for where the frickin' money is, I realized that sectors, corporate sectors in information, retail, trade, and manufacturing and banking have way more cash than they ever have had before. In fact, if we just look at the last year, we'll see a massive rise, somewhere between 50 to 100% of an increase in the amount of cash firms have available. But it's not just firms. On average, the personal savings rate, and this doesn't mean everyone's savings rate, but it does mean on average, the personal savings rate is 2 to 3x the levels where we used to be. This is where we used to be. This is where we sit now. Substantially higher savings, substantially higher cash. Now, maybe that's because we're stuck in a pandemic and people are having trouble spending the frickin' money. But we've also seen housing prices up 10 to 20%. We've seen the S&P and the Dow up 24 and 14% respectively over the last year and 3 months. So in other words, the money is flowing. All of this money printing that we're doing is leading to substantial increases in the amount of cash people have available. And this is leading to a lot of concerns that, wait a minute, all of this increase in money at some point is going to lead to inflation. How could it not lead to massive inflation? And this is exactly where we get a divergence. We get two potential scenarios as to what could happen with inflation. And I'm sure there are potentially scenarios in between these two, but let's talk about the two scenarios. First, what society seems to believe right now, and second, what the Federal Reserve believes society really thinks. And this is where we could really go tinfoil hat in terms of what's happening. But let's go down the scenarios. Scenario number one. Since the velocity of money plummeted during the pandemic, or the rate at which money circulates because of shutdowns and restrictions, we've been able to save up money and hoard cash. And as soon as the reopening is in full swing again, that is, we're all going to be able to spend money again, we're in for massive inflation, as all of a sudden everybody goes out and spends money on products and services at the same time. We'll see supply shortages not just in semiconductors and houses and building materials and used cars, but in everything. Computers, phones, TV, clothing, household supplies, energy, everything. Some say we'll even revisit the days of the 1980s. We'll see 10 to 14% inflation again. Some say it won't be that bad. Some say it'll be like 4 to 5%. But yes, we will have enough inflation to lead the Fed to panic, forcing the Fed to jack up interest rates to combat high inflation, leading to variable rate loan costs skyrocketing, creating not only a skyrocketing in bond yields, but also likely leading to corporate and personal defaults, leading to foreclosures and variable rate backed real estate, as non-fixed borrowing costs end up destroying anyone or anything that is over leveraged. This could essentially lead to a Ray Dalio-style Great Reset, where the economy goes through a painful deleveraging, where people either try to get out of debt by saving and paying down their debt, or through bankruptcy and screwing people who were owed that money. This could lead to ultimately a decade, potentially, of restricted spending, leading to an economy that spirals downward. And unfortunately, because inflation would be high, it would be very difficult for the Federal Reserve to actually print their way out of this, because the additional printing would just lead to the inflation, or lead to more inflation, which could literally lead to a collapse in any remaining trust of financial institutions, leading Bitcoin to $1 million, a dark depression, the likes of which we've never seen before. That would be so bad that even if we don't end up going into a dark depression, any degree of this could end up leading, or would end up leading, to some form of very dirty and nasty recession. That is one possible scenario. And that is a scenario that a lot of people are deathly afraid of. In fact, some argue that, Kevin, what you just described is exactly why Bitcoin is skyrocketing. At the time of this filming, it is approximately $61,800, going straight up as I'm filming this video, possibly going to hit $62,000 before I even get a chance to post this video. But then there's the Federal Reserve's argument. See, the Fed agrees we're going to see an explosion of spending as the economy reopens. However, the Fed believes that this explosion of spending won't last. For example, if all of a sudden there's an explosion of spending that leads to inflation in, let's say, airfare or computers or iPads, people will simply delay their travel or their purchases of goods or services because those goods and services are in short supply, and rather than prices going up, people will just delay the purchases of those products until prices come down again. People will just delay traveling to an overcrowded Disney, because who wants to be at Disney when it's overcrowded? Now, this is because the Fed believes that society, even though society doesn't realize it, the Fed believes society does not think prices will stay high for long. In other words, if society believes prices will go up, then even if things are overcrowded and even if products are in short supply, society will just continue to pay higher and higher prices and we'll have hyperinflation. But the Fed doesn't believe that. And this is a much more complicated argument. The Fed argues, no. People are just going to wait. People just won't pay those prices because people don't expect those prices to consistently stay high. And that any short-term spikes in inflation will just flatten out. It's kind of like how people say, gosh, housing prices are so expensive right now, I'm just going to wait. Well, the same could happen with travel products, goods, and services. Rather than pay more money, people will just choose to wait. It's kind of like what happened when there were gas shortages. Now, this gets complicated, and we're not going to go down into the world of gas shortages, but what happened when there were gas shortages? Prices went up, and people had to pay with their time. Now, because they needed gas, they also had to pay the higher prices, right? You don't have a choice not to get gas. But people end up paying with their time. When prices go up and there are shortages, people pay with their time. And that same thing could happen again, except people won't be forced to travel or buy goods and services. And so when they pay with their time, they'll just delay gratification, and we won't actually see that inflation. In other words, price increases will be temporary. And the Fed believes that as long as society truly thinks that these price increases will be temporary, there will not actually be inflation. Now, this is bizarre because what this does is it actually takes society and uses society believing that prices won't stay high as a tool for legitimizing all of the money printing that has happened. All of the crazy money printing will just get legitimized. This massive transfer of wealth we've seen from poor people to the rich, where the rich have gotten richer, people owning assets, stocks, real estate, and businesses getting richer and everybody else getting screwed, will be legitimized as everybody else gets left behind. But it's the course, like this craziness is literally the course the Fed believes will be reality. The Fed believes, let's let inflation spike to 2.5 to 3%. It's not going to go much higher, and even if it does, we'll handle it, they say. But after this minor surge, we expect inflation will settle back down, hopefully to 2%. And that'll be a success for us. And we'll slowly get back to normal policy like we had maybe in 2016, 17, and 18. Those in scenario 1 say, dude, no, this is impossible. Anytime countries have printed massive amounts of money like this, all they've accomplished was the massive dilution of the people's currency and ultimately leading to the collapse of fiat. Think of Zimbabwe. Think of the wheelbarrows of money in the Weimar Republic. But those in scenario number 2 say, not quite. Inflation isn't actually related to money printing. Remember, inflation is the increase in consumer prices year over year. Inflation actually happens when people lose trust in their government, those in scenario number 2 say, not because of uncontrolled spending, ironically. Now, when a country like Zimbabwe loses control of inflation, it's not because they spent a lot of money. It's because they spent a lot of money without trust. That the government just frivolously spent money on any government project without constraints. Spending the people's money with zero constraint led to a loss of trust. And as soon as trust in currency was lost, inflation takes off. See, those in scenario number 2 say the United States has a unique advantage here. Not only are we the world's reserve currency, we're the control the petrodollar, we are the petrodollar, that is, oil is traded in the US dollar. But of the countries in the world, some argue that the United States has one of the highest levels of currency trust. And see, this whole inflation thing gets a lot more complicated. Some say this actually has to do with our two-party political system. Because of the frequent gridlocks that we see between Republicans and Democrats, spending money in America is notoriously difficult. Consider situations where Democrats like Joe Manchin or Kyrsten Sinema fight against excess spending, eliminating potentially, or even the Senate parliamentarian, eliminating the minimum wage increase, eliminating a bridge for Chuck Schumer, eliminating money for Nancy Pelosi's BART system in her district, eliminating, or limiting rather, stimulus checks further, limiting unemployment further. Even though they're on the Democratic side, which could have the power to spend more, the Democrats still get restrained. Why is it, or consider, how people like Bernie Sanders don't ever seem to get their policies through, like universal basic income or minimum wage. And these constant fights that happen, that are very popular, but end up getting shot down because of a fear of spending too much money, potentially frivolously, actually leads to more trust in the US dollar, which actually reiterates why there might not be inflation. See, despite the insane spending we've seen recently, the pressure to keep spending low is so high in America that our broken political system and the gridlock of our political system actually makes our currency feel more trusted. And so scenario number 2 shows us how complicated inflation really is. Inflation isn't just pure money printing. It's not just purely affected by the velocity of money because the linkage between that relationship is not very strong. At least not over the last 20 years. Things could change, but historically it hasn't been very strong. Inflation has not consistently aligned with the velocity of money. And inflation may also not be affected purely by a sudden spike in demand like reopening because people might choose to spend their time waiting rather than spending more because they believe that inflation will not be permanent. And see, this is society, again, legitimizing the money printing that has happened because we trust the money printing that we have done more than we trust the money printing of, let's say, Zimbabwe. As crazy as that sounds, and I certainly don't want to say that you 100% trust the government, I'm saying relatively, amongst the countries in the world, the United States currency has more trust and potentially could legitimize scenario number 2. This could lead prices to stay stable. This could lead to periods where products and services are in short supply, or people end up delaying vacationing because everything's crowded out, but eventually leads to what I like to call a frugal decade. We have cash and we're investing more because nobody wants to go through what happened again in the pandemic where you were stuck without cash and you got screwed and the rich got richer. Everybody realizes now that it's the people with businesses, real estate, and stocks that get wealthier. People realize that the reason I have courses and programs on building your wealth is to help you actually build your wealth. I don't just talk about, make passive income by buying an AT&T dividend stock. I actually teach you how to build your wealth, which that coupon code from any of my amazing programs linked down below does expire in 2 days. But anyway, it is possible that this pandemic could have been the greatest force to convince people to build wealth and invest and not spend as much, which could reiterate the lack of inflation that we could potentially end up seeing. And so this is where I have to ask you, what scenario do you think is more likely? Scenario number 1, we see mass inflation that's permanent inflation, persistent inflation that leads to a great recession or depression with massive deleveraging and bankruptcies. Or will we just see a more benign scenario number 2, where we see the roaring 20s, The government gets away with a 25% plus increase in the money supply, with many people much wealthier off, especially those, again, owning stocks, real estate businesses. But we don't end up seeing persistently high prices. We see short-term spikes. And ultimately, inflation ends up balancing out around 1.5 to maybe 2.25%. Well, I'm going to leave the answer up to you. Let me know what your thoughts are in the comments down below. And if you want to learn more about my perspectives on building wealth with real estate, stocks, property management, sales, or building wealth by making YouTube videos, take a look at the courses down below. There's a 38% off coupon code that does expire in 2 days, and I'd love to have you as part of the group. All of the groups come with private live streams every day the market is open, lifetime access to the content, chat rooms, and folks, in the Stocks and Psychology of Money group, my buy and sell alerts for stocks as well. Thank you so much for watching, folks. We'll see you next time.